Well, hello and happy Friday. It is the 8th of December, one day after the day that will live in infamy forever, which was Pearl Harbor Day, December 7th. I am Delbridge, Benchmark Realty, Murfreesboro, Tennessee. Now, if we return to our opening segment last week, we had the SEC Championship. We are running out of college football for this year, and we have a little bit more to go. Now, what do we learn from the observation that a number 8 Alabama one-loss Crimson Tide could actually dispatch the number 1 team in the nation for multi-weeks at a time? The unbeatable was beaten. Their dynasty of 2 years is now over, and people were quick to declare the old kingdom of Saban and Bama gone. And what do we learn from this? The numbers sometimes don't really represent the reality. And that's something that's very, very real we need to get into. There are a lot of emotions in a lot of things. Football is just one of them. And speaking of emotions, we hear that the Seminoles feel slighted because they were a perfect season in their conference. The problem is not all conferences are created equal, just like not all people are created equal. And people get mad about this, and they'll probably just need to burn their anger out. But next year we'll have a different playoff format. That may be better to see how it goes. Now, if Florida State is really deserving of one of the final 4 positions, now that they are facing the Georgia Bulldogs, they should easily dispatch the former number 1 team in the nation and top of the SEC East. If they're that good, if they deserve to be there, they ought to whoop them pretty good. And somehow I don't think that's going to happen. My take on it is just this. I'm not trying to play favorites with the SEC, really not. But when you have a number 8 beat the number 1, the number 1's being there for almost all of the season is worth something, even if it is just 1 game loss. The Alabama knocking off the Bulldogs, that certainly earns them a spot because they were number 1. So who goes away? I would say Texas and Florida State. But now the politics of college football and how all the green grease that makes the programs work, they may not want to see an SEC rematch in the final again. They simply they have 130 schools or so in the NCAAF, and the Power 5 or who they are. Some people just think it's unfair to have that much domination, and there's some jealousy and some emotions, and sometimes we have to let those emotions burn themselves out. So we learn that unexpected things can and do happen, even when all of the experts say they can't. So let's get over to our middle segment. If you like this content, please go to CallDelToSell.com, find the tab that says on YouTube, click it, and it'll open up a page of QR codes. There you can use a smartphone to scan and get to the YouTube page, or you can just mouse over and click it on a PC. There you'll be able to subscribe to this little button over here and click the notification bell so that YouTube will notify you when each Friday's blog has been uploaded. Thank you. All right. In this part, we're going to talk about a couple of things. You know, we've seen the mortgage rates have dropped a little bit because we didn't get a couple of rate increases we should have by the macroeconomic numbers. We should have had some increases we didn't get. And several people, a great number of people, learned people in their industries are betting that we are at peak rise, that the Fed is done. However, I've been telling you, if you've been watching, we're getting very mixed messages from the economic data. Now, I can't guess what the Fed is going to do, and you can't either. So it gets to be a bit of a sticky wicket if we're trying to time the market and guess what the Fed is going to do. The reality is as we close out December, the 4th quarter on the GDP is looking to be higher than hoped for. We're still expanding the economy. We have gone from below 1 to above 1, and the range of certainty is narrowing. So that's coming in hot. We also had a hot GDP in quarter 3, which was twice what it was expected to. So we're not raising rates fast enough in a macroeconomic national budget type of situation because we're still spending money, and we still have a lot of money that needs to be bought back. So that is uncomfortable for a lot of people to deal with, but that's just the way it is. What bothers me most, and you've heard me complain about this in the past, is we didn't go hard at it fast enough. We could have possibly been over this had we actually been more aggressive, but that would have shocked the economy. And perhaps the shocking of the economy, the emotion of shocking the economy, would have gotten us over this quicker. We also see we had some job numbers come out today, and they were significantly lower unemployment than they had hoped it would be. So we're still adding jobs. We're still putting that on. That's a positive indicator the economy is doing well. We have the GDP going up, which is the economy doing well, and we're trying to cool the economy. So when we see other segments, sort of like inflation is allegedly coming down, at least how it's measured, it seems to be improving. We still have the money dump from 2020 that got into the economy, and that's just not going to go away anytime soon. But the economy is not the basis for today's talk. Well, the inspiration for this particular segment comes from social media. Social media can have some good information, it can have some misinformation, some disinformation, and some other evilness about it. But in this case, the inspiration was a post from someone in the industry who had seen a property advertised as being subject to a short sale with the approval of the lender. And someone else made the comment, well, they weren't very well seasoned, but they'd like some input. Isn't this a great opportunity for assumable mortgages? And my response, I chimed in, just trying to be helpful. No, I don't really think so. They're two different things. And the response is, well, I know they're two different things. And I don't really understand your question then, because a short sale is when the property sells for less than the debt. And I don't expect to see a lot of those right now, simply because we're in a market that's pretty hot. Even though we've slowed down, okay, it's still a high demand market. And being a high demand market, we know that foreclosures or deed in lieu of foreclosures or even short sales are all in kind of that bailiwick of distressed homes in trouble. And there is a cost, obviously, to foreclose. And I understand, I've been informed that a lot of deeds, we have the redemption phase. They may have waived the 2-year period that might be available to someone. And if they happen to have, if the previous loan is set up to have a waiver, say maybe a 1-week waiver to have your equitable right of redemption, it may not be that difficult for a bank just to foreclose on the property and sell it and get their money. They may even do better than the debt, in which case the proceeds should go to the property owner. So a deed in lieu of foreclosure is where someone is in trouble and they just agree. Usually they won't have a lot of equity in it. It might be something like a USDA loan that was purchased with zero down or something of this nature. And so they don't really have much to lose and they can't keep it. So they just surrender the deed and it goes to sell quicker and easier. But all of that is in the bailiwick of foreclosures and distressed properties. Now, I have to give you a little bit of a disclaimer that I am not licensed as an attorney nor a loan originator or broker in that area. I don't have experience in there, and I have to speak in generalities. However, I do have an article pulled up from Investopedia that we'll get to in a minute, and it has a lot of good information. It seems to be current, and again, I'm not an expert at these things, but I do want to address this kind of thought, that an assumable mortgage is some sort of a panacea that's going to make life much better in these Bidenomic times under this economy where we see high rates on the mortgages caused by the money supply being out of whack, and then the Fed's policy of raising the target rate that filters indirectly into higher mortgage rates. It's not necessarily going to get you maybe what you think it will do for you. Well, let's rewind the tape a little bit and look at what we learned from the pandemic. We had pent-up demand, we had bidding wars, and one of the things that we saw was things were going very, very quickly, that we could, in some cases, have things almost sold before they were fully prepped going to market. People were buying houses without necessarily seeing them because they were coming from other places and had plenty of cash that helped inflate those prices or give a great deal of appreciation very quickly in the market. So we know we can have that. We know that cash was king back then because it meant that people could put a house on the market and get out of it and get the transaction closed very quickly. A step away from that are people that would have to have it financed. And of course, the better the position of the persons trying to get the house was ensuring that it may go through, and it dealt with how much cash could they cover an appraisal gap if they bid up and it went higher than what the market value was. Could they cover it? So your worthy and well qualified people did a little bit better, even with a loan, whether it be conventional or one of the government loans. If we step further away from that and we look at people who want to get into a assumable loan because of a favorable rate, it's not just the rate. That is a loan that exists in the prime or first position, and it is just being taken over the remaining debt. Okay, so it's just the remaining debt. It's not the full purchase price. So if we have a house that, let's take scenario number one, that we have a house that was purchased right before the big boom and it was in that low rate, let's say 3%. We might want to hold on to that 3% if we were buyers because we could pick up the house. However, we have to qualify for the terms of the loan, and that requires the lender approval. The lender has to approve the transfer of debt from the person who originated that loan to the new person, the seller to the buyer. And there can be terms and conditions that have to be met, such as if it was a loan that has to be a primary resident, then your investors and second home people may not be able to pick it up. If it was a conventional loan, the article, which I'm going to show you in just a few minutes here, it says that most of the conventional loans sold under the Freddie Mac and Fannie Mae, under FHA, most of those conventional loans are not assumable anyway. So that takes those out of it, and we start to protract the transaction because this gets complicated, getting these approvals and getting all this set up, so it becomes even less desirable. But if the market is slow, it may be an option. But now let's take a look at that house that was purchased, say, 3 years ago on a 30-year note. Well, then we would be in a position of having only 3 years paid off on it. And you might say, well, that's good because it's almost all interest, and so there wouldn't be really much made into the debt. Well, that could be true, but you still have to deal with that 3-year massive growth period that we saw post-pandemic, because that's the market value of the house. And so that adds equity that has to be funded. All right, let's look at this article that we have from Investopedia. Investopedia up here, and it says Assumable Mortgage. What is it? How it works? Types, pros, and cons. And this is written by Julia Kagan. I'm guessing at pronunciation of her name. Updated December 1st, so that's only 8 days ago, 2023. Reviewed by Margaret Chang. And it is fact-checked by Pete Rathburn. And this is an Investopedia article. And it seems to be fairly current. So I have a little spot here. It says, what is an assumable mortgage? An assumable mortgage is a type of home financing arrangement where an outstanding mortgage and its terms are transferred from the current owner to the buyer. So it's an existing mortgage. Most likely it's going to be first position. We'll assume it's first position for our argument. And it says, by assuming the previous owner's remaining debt, the buyer can avoid obtaining their own mortgage. I think this causes confusion for some people. People think they can just assume a loan and that's all there is to it. And if they can find one that's assumable, they'll get one that was assumable at 3% or so, save a bunch of money, and they will avoid that Fed rate and the high inflated rate of mortgages. But that's not what that says. It says by assuming the previous owner's remaining debt, the buyer can avoid obtaining their own mortgages. That means they're going to have to cash out quite a bit of money to pay any equity that's there. A 3-year-old loan of a 27 years remaining, there's not a lot paid in, but we still have that equity. Different types of loans can qualify as assumable mortgage, though there are some special consideration to keep in mind. And the first would be the amount of equity. That would have to be fully funded. If it's not fully funded, you would have to take out a second mortgage, and that second mortgage would most likely, since it can't be first, would be in second position. So we'll look at two scenarios here pretty quick. We kind of talked about the first one, that 27 years remaining on a 30-year note. Now, let's take a second scenario where it might seem to be helpful, but it's really not as helpful as you might think. Like let's say that someone bought a property and built a house on it. Say they paid $100,000 for the land and they paid $150,000 to build the house 20 years ago. That rate may have been 5% or so, and they paid on that for 10 years. Well, after about 10 years, they're paying into the principal of that loan. Now, when the rates dropped, if they refinanced and didn't take cash out, they refinanced the remaining amount, which may have given them the ability to double up on some payments and kind of get that thing whittled down another 10 years or so, whatever the span may be. We have 20 years of appreciation that's in there. Say the house now is at $600,000 and they only have $125,000 remaining. Well, you're only able to assume the remaining debt of that loan, which would mean that you're only getting a lower rate on $125,000, which 125 from 600 would be what, $475,000, which would mean you would have to have $475,000 cash to pay that equity off in order to clear the purchase price. Because the purchase price is what is agreed upon, and if the assumable portion of the loan is low, assuming you can even assume it, it's going to probably require a second mortgage unless you have that money, which means that's really not a possibility. And as we take these complications, we go into a much more protracted situation where it's not just as simple as they've got a good rate, let me get to it. It's only going to be a good rate on the remaining debt. If you don't have the cash to do it, it's going to be a second mortgage. And because lender approval is required by both sides, it's highly unlikely in a scenario that in a ratio like that, that either side will approve it. Because two mortgages increase the likelihood that the property will go into default. So it may be more beneficial to someone to go ahead and find the house that they can afford and pay for at today's rates. And if that way we only have one mortgage to deal with, they clear the old mortgage out, even though it may have had a better rate. They clear that mortgage out, sign the new mortgage, and if the rates fall as expected, it may take 5 years, it may take 10 years, but if it falls down enough, they can refinance and take advantage of that lower rate. Because then they're on their own. They can go conventional if they want. If they have 20% down, they may be able to avoid the PMI. If it's a VA loan, we have to take in consideration as the seller, will you be able to clear your loan away and take your VA benefit to the next home? That's something that they would need to talk to the Bureau of Veterans Affairs to verify. And all of this takes a little bit of time to get the stuff squared away. Now, we talked briefly about the initial conversation on the social media it was a house that was subject to a short sale. That's probably indicating that the loan is not in great shape. And according to this article that we're going to get to, when we slide down through this, going down here to the section, and this will be available for you to read. I'll post the link in the description of the status chat over on the YouTube page where it is. It says down here on the USDA loan, it says that they're located to rural property, so not all are eligible for USDA. They require no down payment and often have lower interest rates. To assume a USDA loan, you must meet the standard qualifications such as meeting the credit and income requirements and receive approval from the USDA to transfer title. You may assume an existing rate of interest in loan terms or a new rate terms. And it says here, this is the big part, even if you meet all of the requirements and receive approval, the mortgage cannot be assumed if the seller is delinquent on the payments. So if we're in that distressed condition, if it's a USDA loan, you're not going to be able to change it over, but you may qualify for a better rate than you could if it was, say, a city property that isn't able to take advantage of the USDA program. The VA loans, it talks about this being 1988. They're all assumable, but you have to consider whether or not the VA will approve you to take over that loan. Now, the article does state that the veteran who originated the loan, you don't have to be a veteran to assume that VA loan. But what the veteran needs to check to make sure that that isn't his only VA loan, that he gets totally free and clear so that he can take his benefits over to the new property if he chooses to buy a new property. Now, the FHA loan is a little different, that it says they're assumable. Both transacting parties meet the requirements for the assumption. It's not one-sided, not unilateral. For instance, the property must be used as the seller's primary residence. So if the seller, it was his primary residence, and the buyer is looking for a second home, a vacation home, a lake home, whatever, they're not going to meet that primary resident requirement. And so they're not eligible to take it. If you're the buyer, you must first verify the FHA loan is assumable and then apply for the individual FHA loan. And again, we have the problem of equity, because we're going to get into that. Let me see if I can find that in this article. Here we have advantages and disadvantages of assumable mortgages. We have pros and cons. Pretty easy even for me to understand. The pros, we'll start here. The rate on the mortgage may be lower than current market rates, which is why we would assume it, why we'd want to assume it. May not need to apply for a new mortgage, but that's going to be your cash dependent based upon the equity, which is kind of what it says here in the next statement. If the seller's home equity is low, as in the first scenario, just 27 years remaining on a 30-year loan, and the growth has not been, the appreciation has not been too substantial, there are less out-of-pocket costs for the buyer because they don't have to have a second loan. Now, the cons are going to hit that just the opposite side of that coin. You may need a substantial down payment when the seller's home is high. The equity is very high. We've talked about that. The lenders may not cooperate when a second mortgage is needed. And notice that that's plural. They put this as a plural, lenders, because if the equity is high and the second mortgage is very high, they may not want to be in second position. The first mortgage may not want to do it if you have to then borrow that much money just to assume the loan, and it may not be cost effective in the long run as well as strategic in your purchase, in your transaction. With two mortgages, the risk of default increases. And so since each of these lenders would have to approve you, that can make an assumable mortgage not quite the panacea people think it is. So I hope I haven't talked too terribly long and not been overly specific, but again, I'll give you the link to this in the description so that you can read the whole thing at your leisure, but understand what you're dealing with. The only way you avoid a second mortgage is if you can pay the cash and take over the existing one. And if you have to have a second mortgage, it may not go, it may not float. So I hope you smell what I'm cooking here, and I hope it's been worth your time to sit through this middle segment. Thank you. Let's wrap this puppy up. Hello, I'm Delbridge of Benchmark Realty, Murfreesboro, Tennessee. If you are currently unrepresented and would like to know how to compare up to 3 properties side by side and room by room, then go over to my new YouTube channel, CallDelToSell. That's 1 L and Del, no spaces. Watch the demo on Real Scout, and then call me and we'll set up your exclusive ad-free account today. All right, let's look at last week's numbers. For the week of 12/1/23, we had 20,082 in the opportunities. That was down over the previous segment. We had 3222 in the under contracts still showing. That also dropped just a tad, but the ratio remained steady for the third week in a row at 16% between those two numbers. This week, 12/8/23, we have 20,347, which is up a little bit over the previous period. We have 3155 in the under contracts still showing. That decreased a little bit, and yet the ratio, integer ratio, remained just above 15.5 at 6, so it rounds to 16%. So there we are. I hope that this hasn't gone on too long, and remember, I'll give you the link to this Investopedia article so that you can fact check it on your own at your leisure. Appreciate you watching. Share me with your friends. Do the click, like, and subscribe type of things when you see me in social media, and we'll keep in touch. Thank you.